Hello, I'm Lindsay Konzak, editor of Modern Distribution Management. In the past half-decade, we've seen a lot of ups and downs in the wholesale distribution mergers and acquisitions market. The market was hot in the mid-2000s, only to see activity come to a near standstill in 2009. According to a recent report from Robert W. Baird & Company, the number of deals between 2005 and 2010 hit their peak in 2006 and 2007. M&A activity slowed significantly in 2008 and 2009, followed by a doubling of activity in 2010. Many of the deals that were completed in the past couple of years were for high-quality companies, according to Kurt Tatham, Managing Director for investment bank, Lincoln International. Tatham leads that firm's distribution group.
What we really saw was at least arguably all the distribution companies that were sold last year were very high-quality companies, because early on last year the capital markets were getting better, but weren't clearly as strong as they are now, and so the companies that were being brought to market were those that were diamonds in the rough that had managed to perform through the cycle or outperform on a relative basis. And combine that with all the capital on the sidelines, both strategic and private equity, and you ended up having a bit of a food fight for the high-quality companies, and the multiples reflected that.
Still, 2010 dollar volume was well below value seen in 2006 and 2007. In August 2010, I spoke with John Skelly, who at the time was with Bettis Partners and has worked in business development with Hughes Supply and later Home Depot. Skelly, now with Grainger, told MDM in August that the M&A market in distribution at that time was still shaky. He said that M&A is all about confidence and courage, and when there is a wavering of confidence in the economy, people tend to step away from transactions, or they tend to lower valuations. That shaky environment seems to have passed. M&A activity has finally picked up again, and industry experts expect it to continue to be strong through the end of 2011 and into 2012. Jim Miller, co-founder of Bettis Partners, a distribution-centric advisory firm, on current trends.
What we have going on right now is, in 2010, there were a lot of deals that were essentially pulled forward. Remember, everybody thought that the tax changes were going to be coming at the end of 2010. So that pulled forward several transactions where companies would not have normally sold for probably another 2 to 3 years, but they pulled them forward into 2010. And then once the tax laws got extended, some did pull their companies off the market, but several other ones, they were too far along and they just went ahead with the sale process. So what you did was you pulled forward a little bit of the 2011 demand into 2010. So some of those deals, are still getting wrapped up, and there's a little bit of a lack of supply on the new deals, but it's starting to pick up already. We expect a lot of M&A activity here in the back half of 2011 and 2012 as well.
So what's driving the demand? Well, to put it simply, both strategic and private equity buyers have cash to spend. Miller, who is also a principal in Supply Chain Equity Partners, a distribution-focused private equity firm, says demand is driving deals right now.
The driver primarily right now is on the demand side. And, there's a few things that play into that. Number one, there is a pile of uninvested private equity dollars from funds that were raised in 2007 and 2008 in particular, because 2009 was pretty much a dead year, for deals. And if you look at those funds, they're typically 5-year investment funds. So they should be theoretically investing, 20% of their dollars each year. Well, with a lost quarter in the fourth quarter of 2008, and then just about a lost year in 2009, there are a lot of funds that are well behind on their investing schedule. So you have a tremendous demand out there right now. There's probably $1 trillion of buying power in the private equity market right now. If you look at, the dry powder that's reported, which I think the last report I saw was about $500 billion in dry powder, and I would be willing to bet a lot of money that those numbers are understated. And then if you look at, leverage ratios, you're talking about, at least $1 trillion of buying power on the private equity side.